Good morning, everyone. It's Derek O'Dwyer here from Action Coach. I'm joined on the call this morning by Kevin Moore from MG Ryan and Company Solicitors.
Hi everyone, thanks for being here.
Okay, we'll make a start anyway. There's going to be two parts to the presentation today. One is about getting started in business, and the idea is that we get started with confidence. Could one of the participants just raise their hand there if they can, just to acknowledge that they can hear what's being said? Um, there's a little icon at the bottom of the screen. I think if you can raise your hand, or just type in the text in the chat section there if you can hear me clearly before we start talking too much. Okay, thanks, Morgan. That's very good. Okay, so we'll make a start then. I'll do the first part, and then Kevin will come on and he'll talk legal for us all. So the way it's going to go is that I'm going to talk about the top 5 things you need to do before you spend a cent when starting up a business. Then I'm going to go through the top 4 business growth strategies. I'm going to cover 4 areas, and I'm going to give you some topics within each area. So because of the brief nature of today's webinar, I won't be spending too much time on any one particular item. But what I would suggest is if you're interested in finding out any more about any of them, that you just drop me an email at the end, and I'll happily send you as much information as you want on any particular strategy. In one sense today, it's a bit of a brain dump, and that we're kind of trying to give you as much information as we possibly can, that if you're in the business of starting up a business, or if you're thinking about starting a business, you go about it in the right way and get off to a good start and start making a profit from the outset in your business. And then we'll cover the legalities of it. So depending on whether you're setting up as a sole trader or whether you're setting up as a limited company, whether you plan to take on employees, whether you plan to take on partners, Kevin will go through all of that, all those aspects. And some of the things that we cover are things that people can brush over in their enthusiasm to get started. And invariably, when that happens, they encounter problems later on. So while we're not trying to curb anyone's enthusiasm about starting a business, we're asking people to do it correctly. And it's a marathon rather than a sprint. And you're better to spend an extra week getting ready than you are spending months trying to unravel problems later on. So that's how we'll go. So the top 5 things, I'll make this screen bigger just for the presentation. The top 5 things that we're advising that people need to do before they get started is, number 1, get a proper plan. That's the first thing. And normally when I'm speaking to people about planning, their eyes tend to glaze over at the whole thought of a plan. But without a plan, you're going nowhere. I then advise people to obviously seek advice and surround yourself with good people. I'll cover again about money mastery, because whether you like it or not, being in business is about making a profit, making money, turning over money. So while you don't need to kind of love money, you need to love the idea of making money and understand that business is about money and it's not a dirty word and it's okay to make a profit. Next thing then we go on to is destination mastery, which is basically, why are you in business in the first place, and why are you doing this, and are you clear about the commitments that you're going to have to make and the sacrifices you're going to have to make in order to make your business a success for you. And then we look at time mastery, which is critical in business, and we find that lots of people get sucked into business. They become very, very busy, but they don't necessarily make lots of money. So how you spend your time is going to be the best reflection of how successful you're going to be. And I just put a PS down there. It's also important to get started, because spending too much time doing nothing, you'll never know whether it's going to be a success unless you actually dip your toe in the water and then dive in really. But that's the next stage. The first thing then is a plan. Now the plan serves a number of purposes, and in one sense you need a plan if you need to go to the bank, you need a plan if you want to raise money, you need a plan if you if you just want to kind of give yourself an idea or to kind of formulate an idea. But the main reason that we get people to do a plan for their business is really to take them through the process of starting a business. A plan is a series of questions that you get asked in that: have you researched your product correctly? Have you researched your marketing? Have you researched your market? Have you researched your competition? What are your goals? How are you going to determine your success? What team do you need? So all of these things are critical to the success of your business, but most people simply don't have a plan. They haven't it written down, they have the plan in their head. But anything that isn't written down is just a fleeting thought. Whereas if you can commit your ideas to paper, they solidify and they start to make sense after a while. Okay, so and it's not about having the plan sitting on the shelf, it's about doing the plan that's very important. And we've all heard the expression that no bank manager has ever seen a business plan that's going to fail. That's true, and that's not the type of plan I'm actually interested in here. I'm talking about a plan for you which nearly needs to include your life plan as well, because like I said before, when you get into business for yourself, it requires a certain number of sacrifices. The next area then is the team. I'm not talking about employees here because we haven't even got started yet. I'm talking about the team of people that you need to surround yourself with that can help you get your business off the ground based on their experience, their knowledge, and their specific areas of expertise. So I've included things there like mentors, of which I would consider myself one: legal, financial, HR, marketing, sales. So you don't have to hire these people as permanent employees. They're there as resources that you can tap into. Kevin, what's your experience there in terms of being involved from a legal? Are you involved in any teams like this at the moment?
Sure, and I'll explain a bit more about what I do later on, Derek. But yeah, essentially, I work with a lot of startup companies, and those companies will need kind of expertise from a number of areas. And increasingly, our role is to kind of interact with other advisors on the team for a company. So when a company puts together, we'll say, investment documentation and is looking for investors, they'll cite their team, and that might be legal, financial, and as you have them listed there. And increasingly, we find ourselves interacting with good advisors for the company. So yeah, it's an increasing part of what we do.
Okay, very good. Okay, the next thing then after the team is, I suppose we touched on it before, is the basic money mastery. And I met a number of people recently that were thinking of setting up a business, but their financial and their money acumen was poor. They didn't have a good idea of margins. They didn't have a good idea of their basic running costs. They didn't have any idea of what salary they could expect to take from the business. And that really sets off warning bells for me a lot of the time, where people are going in with this rose-tinted glasses about how successful the business is without fully understanding how much it's going to cost and where the profit is going to come from and how long the gap is from when you start in your business to when you actually start making a profit. So we always suggest to people they need to put a kind of a dashboard in their business to give them the indications of how they're getting on. Simple things like keeping track of activities, keeping track of money in, money out, various different things. But people who don't come from a financial background or who are not that financially savvy tend to avoid the money element of the business, and it's absolutely chronic, the problems it causes, because they can often find themselves deep in debt without understanding why they're in debt or why they've lost money or what's one thing is leading to another. I'll give you an example. I met a person today who's thinking of taking on a salesperson, but without understanding the cost of having a salesperson on the road, without understanding how much that salesperson actually, how much time that salesperson would need to generate a pipeline that would turn into business, it was actually a huge cost that he actually couldn't afford right now. And there was a lot of other resources he could put in place in his business before he went down the route of sales. Have you any experience in that side of things, Kevin, from your point of view?
Sure, Derek. Yeah, I mean, I think people need to be conscious, and I deal with employment in the presentation a little later, but people need to be conscious of, who they can afford to take on at the outset and the terms and conditions that they take people on. People are quite open to kind of working as consultants as opposed to employees, and that's often
Yes.
a solution for a startup, or an early stage company. People are willing to do that as a
Yeah, but
consultant as opposed to a full-time employee.
Okay, and just in terms of basic finances, a simple cash flow forecast, a simple budget, and a simple KPIs or key performance indicators is as much as you need. You don't need anything fancy. They're the type of things that can be set up in an hour or two with your accountant just to get you up and running. But don't ignore the money side of the business. The next thing then I'm going to cover briefly is the destination, and I suppose this really covers, why are you getting into business in the first place? Why are you doing this, and where do you hope to end up in 1 year, 3 years, and 5 years down the line? And again, a lot of people don't give this enough thought. Now, this serves two purposes as well, in that if you're clear about your vision, you tend to deal with obstacles and challenges in a different way than if you're not clear. You tend to deal with obstacles as kind of stepping stones towards your vision, because your vision inspires you and it motivates you. The vision also serves a purpose when you're actually talking to customers, and it also serves a purpose when you're looking for investment, things like that, because if you're clear, it's a lot more easy for people to buy into what you're actually doing. Have you come across much of this, Kevin, in the biotech and the IT sectors in terms of when people are looking for money?
Oh, absolutely. I mean, any investor in a company is thinking about the exit. So if the person looking for the investment hasn't thought about the exit, hasn't thought about where this business is likely to go, then there will be no investment. If you get me, people
Yes.
want to have certainty. They want to have an idea of how they will make money from a company. And if the founder hasn't thought about that, well, then an investor isn't going to be, their interest isn't going to be tweaked.
Okay. Very good. Thank you. Okay, the final one then in terms of the top five is a time mastery, and we'll all have heard all the sayings about how you spend your time and things like that. It's critical. We're all given the same number of hours every day, but we all use those hours in very different ways. And we often say that people judge your success by how busy you are, but really that's a completely wrong thing to do, and both you and everyone else should judge your success in terms of how productive you are. It would be far better to do 2 decent hours work in a day and get loads done than spend a day doing nothing but thinking you're busy. So, very briefly there, yes, time spent, preventing things, time spent putting systems in place, time spending understanding how to get the most out of your team, time spending understanding how to develop your product is all good stuff. If you find yourself in a business where you're very, very busy and not making any money from the very early stages of your business, it's time to stop and rethink what you're doing, because you're once you max out on time, it's quite difficult to grow a business. So just make sure that you're spending as much time as you possibly can in the zone there, which is stuff that is not urgent, but it's important. Okay, so and people again, they judge you on how busy you are, but that's not any measure of your success. So if you're getting into business to be successful and to give yourself a lifestyle, just make sure that how you spend every hour is critical. So you really need to be a time miser. And when where you sit down for a 2 hour meeting, you should be saying, could we do this in half an hour because I've got other things to do, and kind of take back your time, take control of your time. I suppose an example of it would be today we're doing a webinar. We're all sitting in our own desks where no one has traveled to be here today, so we're saving time. We're trying to give loads of information in as quick as time as possible to allow people to get back doing what they're doing. Okay, in terms of the growth strategies, then again, you might need to make a few notes here because I'm just going to cover them briefly. There's four growth strategies, or there's four areas of your business that can actually help your business to grow. So they're kind of categorized in terms of marketing strategies, sales strategies, service strategies, and retention strategies. Now, I don't have individual slides for these, so forgive the lack of animation here. But if I just take you through the marketing strategies that exist first, everyone associates marketing with the design, the glamour, creating images, and getting the message out there. And all that is very important. You have to be clear about what message you're giving. But in terms of the strategies that I like to focus on first with clients, is that the first one is called T&M, which stands for testing and measuring. Because the problem with marketing is that not all marketing will work for you. And you've all heard the adage, that only half of my marketing works, but I just don't know which half it is, so I've got to keep marketing. Well, T&M, or testing and measuring, will enable you to track the effectiveness of your marketing to the point where you can start to make informed decisions very early. So as an example, the online guys like Facebook, Google, Twitter, all those guys are experts in measuring. So for example, yesterday I spent €10 on Facebook advertising a particular product with a particular deadline on it. And I could ring up the client this morning and I could say, did we get any sales of that particular product because I spent €10 on it. In addition to that, I knew that the average value of a sale in his business was €40. So he only needed one sale to cover the cost of the advertising. Now, as it happens, he got 5 sales from that €10 spend. So he averaged €250 from his €10 spend. So we can then make the call, is it worth doing something like that again? It is. But a lot of the time, people just don't take the time to measure, and then they start newspapers, radio, um, all the wrong areas for business because they have no facts to base it on. You have to get your pen and paper out and you've got to say, how much does it cost me? How many do I need to do to break even? And if I do get a customer on board, will I be able to retain them? So therefore, will my marketing work forever for me? That's the first thing. In terms of marketing as well, you've got to look at every opportunity you possibly can when you start up for free. Okay, get your name out there, make sure your message is clear, look to get on the radio for nothing, look to get on community broadcasts for nothing, issue press releases yourself, get on Facebook. Facebook is free, but you have to kind of sacrifice some time for it. LinkedIn is free, but you've got to sacrifice some time. Twitter is free, time. Websites are pretty free now. You've got to sacrifice some time. But you've also got to make sure that your message is crystal clear, and don't be afraid of pushing the boat and kind of standing alone on top of the hill. It's very easy to become a Me Too type business, but you do have to be able to differentiate yourself. So if you're differentiating yourself, don't be worried about what other people think about you. They're not thinking about you that much. Therefore, you've got to do lots and get out there and get your message out there. Understand what your pitch is and tell your story. Free can work, especially at the beginning where people want you to be successful. I touched there in terms of free as well, in terms of online. Online is huge, okay, but and you can waste a lot of time online. But I suppose the big thing there is that if you use it correctly, you can start to build a business over time. Kevin, have you got any input there in terms of marketing strategies from your dealings with the biotech and the IT guys?
Sure, yeah. I mean, marketing is obviously word of mouth, I think, is huge, and you're in a certain industry, but more often than not, markets now are global, and online marketing is the only way to go in terms of, like, in the biotech industry, your market's obviously in the States, and online marketing, online communications, Twitter feeds, they're the only way to go in terms of reaching your target market, for sure.
Okay, very good. Okay, in terms of sales strategies, then again, every business needs to start off with a sales strategy. If you're in business, you're in sales. We find an awful lot of the time that people have negative beliefs and feelings about sales, but no business can survive without sales. The first thing I would say to everyone is to make sure the activity levels reflect the type of business you want. A lot of businesses struggle because they just don't do enough sales activity, and activity will lead to results. If you're doing activity and not getting results, we can look at activity. If you're not doing the activity, we've got to look at you. It's critical that your customers start to refer you, because word of mouth is the best way to grow a business. So you need to have some form of referral type strategy in place. And the final thing then in terms of the sales strategy is that you have to have a sales process to enable you to leverage yourself. So if you're excellent at selling or you follow a particular system for selling and you want to duplicate yourself, then you have to have a process that someone else can follow. That allows you to grow your business. In terms of service then, no business can survive if its customers don't get treated consistently, with consistency. So one of the strategies there is how consistent is the service from irrespective of who they deal with in your company. I always use the same example. I use the example of McDonald's. They built 30,000 restaurants around the world based on consistency. Not the best, but it's consistent, and you know what to expect when you go in there. Having standards, and I always say have your standards high, not so high that most people can't achieve them, but high enough that people can aspire to them, and high enough that they actually set you apart from mediocrity. And the final thing then in terms of services, you've got to invest money training your team, because you cannot assume that they will have had training in any other business they worked in, or even if they've come straight from school. If they don't know, they don't know. It's your responsibility. And the more you train them, the better return you will get from them. The final one then in terms of retention strategy, and this is critical. Sometimes people over or underestimate the value of retaining a customer. But you know, if you can retain a customer, it means you don't have to get a new customer, and you make an awful lot more profit from a retained customer. So you need to understand what the lifetime value of your customers are, so you can hold on to them forever. In order to do that, you have to communicate with them on a regular basis. Not every business um, has reason to contact their clients on a weekly or monthly basis, but you need to find a way, because the longer you leave it without communicating with them, the more they will think you don't care about them, and therefore their loyalty to you is waning all the time. So it's absolutely important that whatever business you put in place, you actually go on and say, okay, I've now got 10 customers. What am I doing about making sure that those are my 10 customers for life? Again, people don't do it. They just assume that they're going to come back. And quite often people drift away from you through no fault of anyone, but the main reason given is that they think that you don't care. So they're the top four kind of growth strategies. So they're probably, rather than strategies, they're kind of areas to look at, but you've got to consider marketing, sales, service, and retention. They all matter. And even if you focus on just one, you'll get big increases in your business. But a lot of people don't focus on any of them, because when they get into business in the very first day, they get busy doing the work of the business. And all those things that I've mentioned there are things where you have to be proactive, and you have to actually plan to do that type of work. Otherwise, it just doesn't happen. Okay, I'll pass on to Kevin, and Kevin can explain how you can use the law to protect your assets. Over to you, Kevin.
Thanks, Derek. Thanks very much. So, as you probably gathered, I'm a lawyer. I work in commercial law. So I work with a lot of startup companies, but essentially what I do is I provide legal services to companies and to entrepreneurs at all stages of their business life cycles, from whether they're sole trader to an incorporated company, to whether they take on their first contracts or take on investment. And I made a conscious decision to work in that area. It's an exciting area to work in, because you get to see a lot of businesses, and you actually get to feel like you've inputted into their success in some small way. But what I found over the years is that there were a number of key areas that I think somebody looking to start a business needs to think about. And it's a lot easier to preempt problems and deal with them before they arise, and make sure they don't arise more correctly, than to deal with them when they actually arise. So most often people will come to us where they have a problem, and to my mind, a lot of things could have been dealt with early on to eliminate the possibility of having problems. So I work with a lot of people involved in business across a lot of sectors. Derek mentioned that I do have a lot of dealings with biotech companies, and that's because I did a fellowship in medical device innovation. So it's run out of NUIG, but the idea is that you have all people from a lot of experts from different areas inputting into a business from the outset, and that's key to the way I run my work. I think that we have a big part to play in getting things right at the outset for a business or a company, so I've kind of distilled kind of what I feel I know about starting up a business down to 5 key areas that I think either they cause problems for people or where I get questions. So I'm gonna go through those for you today, so that hopefully it'll be a help to you as you go through your life cycle of the business. The first one is legal status, and essentially that's choosing the structure that best fits your business. There are options, and sometimes you won't have an option. Like I dealt with last week who is looking to set up a business, and they have got funding from Enterprise Ireland, and a condition of that funding is that they need to incorporate a company, and Enterprise Ireland will take a shareholding in that company. So in that circumstance, there's no decision to be made, but you can remain sole trader if you wish, and a lot of people like to do that. So we'll run through why you might do that, why you might not. Partnership agreements and shareholder agreements, really that's about regulating the relationship between the people you're doing business with and the people you're in business with. Often that's a way of eliminating or preempting problems, dealing with them at the outset. It's very easy to get agreement between shareholders at the outset, whereas when things go on, things get more complicated, and if there's no agreement in place, that's when issues can arise. Employment law. Obviously, as an employer, you have obligations to your employees, and people are quite frightened by that. You know, they're concerned about their obligations when actually a good employment contract is going to nuke all those worries for them. You know, you can deal with it up front. And essentially, the concept here is that you use the law actually to protect your company, and we'll talk about how you do that with your employment contract. Terms and conditions of business is something that I feel is relevant to anyone. It's relevant to our own business here. When we take on a new client, we'll tell people what we will do for them and what we won't do. If you sell a product or a service, you need to have terms and conditions of business, so that if things go wrong, you have some comfort and you're protected and your business is protected. And non-disclosure agreements. What I find with early stage and startup companies that they need to talk to a lot of people, potential advisors, potential investors, and you need to be kind of conscious that somebody isn't going to run off with your ideas, and the idea is that if you're having discussions and those discussions break down, that you haven't given away any trade secrets. So non-disclosure agreements are something that comes up for startups and early stage companies, and so I thought that would be useful to run through. So in the first area, there are a lot of options for setting up a company or for setting up a company or running your business. And by far and away, most people will go with a limited company, where they'll set up a regular company with shares, and their interest in that company is limited to the shares, and their liability to that company is limited to those shares. So there are a number of benefits to setting up a company and incorporating a company to do your business through. Essentially, I've listed three there: separate legal personality, perpetual succession, and liability for debts. So separate legal personality, if you're setting up a company, you think of it like a new person. As a shareholder, you own that company, but that company has rights and obligations. It can enter into contracts, and it can be sued, and it can sue. So essentially, you're stepping back. The company is the person doing the business, and you have an ownership of that. So that's a huge advantage. Whereas the opposite, if you're a sole trader and you're in business and just say you're running a shop, and there's no company, it's just your own name. If somebody has a difficulty or a slip and fall in that shop, well, they're going to be suing you personally as opposed to the company who runs the business. So that's a big advantage. Perpetual succession means that, you know, what happens when you move on and move out of that business. Essentially, a business can have goodwill, so it builds up a reputation over years, so that when you leave that business and you sell your interest, that goodwill stays with the company, and somebody is interested in taking that on and running with it, you know. And then liability for debts. I suppose we kind of work in uncertain times, and we have great ideas for businesses, and hopefully they'll work out. There is the possibility that they won't. So your liability, and I mentioned this a little earlier, your liability in a company is limited to the amount you've invested in your shares normally, depending on the type of company you set up. So if you've bought shares or you've set it up with and you've paid up your shares for a nominal amount, that's all that you'll be required to pay. So if somebody sues the company and you can't pay, the company simply wound up, and that's how business flourishes. But the alternative is, if you're as a sole trader, you might be personally liable for those debts, and you're leaving your personal assets available to somebody to who you owe money. And so obviously there's a lot of reasons for incorporating a company, and as I said in the example earlier, it might be that you don't have a chance to kind of decide. Decision might be made for you, but there are options. So you might ask, well, why would you remain a sole trader or a partnership? You know, a business that's not incorporated. And the disadvantages to having a company are that you have to make annual returns to the company's registration office. You have to keep statutory books, which are very easy to keep, and we help a lot of people with those. Quite easy to keep, but they're an obligation nonetheless. And corporate filing. So essentially, if you have, as a company, you'll have to have 2 directors. If for example, you wanted to have one director resign and appoint another, that sort of detail is lodged with the CRO. They're public documents. People can see who the directors are. And some people, they don't like the privacy aspect, and they don't like the obligation to have to file those sorts of matters. But they're relatively simple to do. It's just it's a factor for some people. So just moving on quickly, and I won't run through this in great detail. If you want to incorporate a company, you essentially need to have 3 documents ready to lodge. A memorandum of association, which kind of essentially deals with how the company is set up, who the shareholders are, how much share capital you're authorised to issue. You'll have a set of articles of association which will deal with how the company proposes to run itself, and what rights do the shareholders have. And then you need to lodge a Form A1 with the company's registration office. The reason I don't want to run through this hugely in detail today is that there's a draft companies bill in process, and it's likely to become law at the end of this year or at the start of next year, where the types of companies will change, and we'll have companies limited by shares, and we'll have designated activity companies. They don't change the reasons you would want to incorporate, but they do change the setup and the form of procedure for setting up. So it's not something you need to worry about for the moment, but I just don't feel it merits going through fully in detail today. Partnership agreements. Partnerships are essentially where 2 people come together outside of a company, so it's not a company, but 2 people do business together in their own names. And in that case, it's really essential to have a written partnership agreement. And the reason is that if you don't have a written partnership agreement, you're bound by the Partnership Act of 1890. And as you can imagine, an Act of 1890 is not suitable for business in the modern era. So you're in partnership with somebody, and you're defined, and your relationship is defined by this Act. And if things break down, some of the difficulties that can arise are in the Act. There's no it doesn't facilitate anybody having a partner expelled. So you can't expel a partner. If you can't say, well, I'm not going to be in partnership with that person anymore, and keep the business going. The partnership dissolves and the business dissolves. One partner can dissolve a partnership. Sorry, excuse me. One partner can dissolve a partnership even if you have 32 members who are all partners, and you're working in business with say 32 people. One of those can just decide, oh, well, I'm going to dissolve the partnership. Also, if one of those partners dies, the partnership is dissolved. You might want to keep it going, but there's no option to do that there. You can't retire. You'd have to dissolve the partnership, and the losses and the profits of the partnership are divided equally. These are all set out in the 1890 Act. And obviously, you mightn't want to run things that way. You mightn't want it that somebody might have contributed more capital than another, and they want to have more capital, and it's loosely defined, and it's not put in paper. And the implication there is that the losses and the profits will be divided equally, no matter how much you've invested in the business. So it's something to think about if you're in partnership with somebody. A written partnership agreement is essential because you cover off all of those issues. And similarly, for a company, if you set up a company and you have shareholders, it's essential to have a shareholders agreement, because, as I said earlier, it's easy to agree matters when things are going well and things at the outset, and we know where the company wants to go, and we're going to do that. But things can change down the line. When you have written agreement, everybody has certainty. I dealt with a company there recently who had 3 founders at the start. They set up the company and everything. Obviously, they divided the shareholding of the company, 33 1/3% each, and everything was going swimmingly. And they decided that was the best thing to do. Now, they didn't have a shareholders agreement. So over time, about a year after incorporation, one of the founders decided, his interest lay elsewhere. His interest lay in another business altogether, and he wasn't too pushed about this particular company. So he decided, well, why don't I just let the other 2 people who came to me, why don't I let the other 2 kind of do the work? I still have 33% equity in that company, but there's no incentive for me to keep going, to not work on another project. And basically, there was nothing they could do. They had a shareholder who was taking an armchair ride. He had 33%. He had a lot of rights in that company, and it was all pretty needless. And I'll go through some of these points and explain why that issue could have been dealt with early on, and it wouldn't have happened. In a shareholders agreement, it's possible to protect minority interests. So you can say, well, nobody can make decisions without more than 30% of the shareholders agreeing. So if or with with all of the shareholders agreeing if you want. You can set it up whatever way you want, but essentially anybody looking to invest in a company will want to make sure that they're obviously going to have minority interests. They want to make sure that they have control over certain decisions of the company. We'll say taking on massive loans or whatever. Unless those rights are there, they're not going to be too interested in investing in the company. Non-competition and assignment of IP. In the scenario I just went through, our shareholder who decided to do nothing in the company and wasn't interested anymore, but wanted to take his profits and his 33% equity and the benefits of everything else, really he should have been made to sign up to a non-compete in the shareholders agreement, that he couldn't compete in that industry for, we'll say, for so long as he held shares in our company. And that wasn't the case, and he was actually working with somebody else on a similar idea in the same area, not directly competing, but there was nothing to prevent him competing directly with this company. An assignment of IP. It's important that if you're working with co-founders of a company, it's important that any kind of any intellectual property that you create, anything that's patentable or copyrightable, that actually is owned by the company as opposed to the shareholders personally. Because if you're all working in a certain area, you should all be required to sign that to the company, and therefore you'd all own it. Founder vesting. This is another way that our shareholder who decided to run off and not do anything and work in a different area, essentially his shares, a mechanism could have been used where his shares vested over, let's say, 2 years. So if he continued to be employed in the company and work in the company, his shares would vest him in equal installments over the 2 years, and that's something that we use quite often in our shareholders agreements. It keeps everybody incentivized, and it means that if they leave after, we'll say 3 months or a year, that the shares that have invested in their name, that the company gets the right to buy them back at a nominal value. So you're not giving away equity for nothing. And it's some founders think, well, this is our company, why should the shares vest over time? And the reason is that to prevent a scenario such as this with our shareholder who decided he didn't want much to do with the company anymore. Preemption rights. As a shareholder, if the company is going to issue more shares, you should have the first option to buy those shares and to follow your money as such, so that you aren't diluted if you're in a position to do so. And therefore, preemption rights is something that should be written into any shareholders agreement. And good leaver, bad leaver. It's kind of going back to our founder vesting scenario, but good leaver, bad leaver means if a shareholder leaves on good terms, well then the company has the option to buy shares at their market value at that time. If they're a bad leaver, like they decide to do nothing and you need to get rid of them, well then the company should be allowed to buy those shares, or the other shareholders should be allowed to buy those shares back at nominal value, or the original value of those shares, i.e. for very little. Employment law is another area that continues to come up for startups, and people are wary of their obligations. And we touched on this earlier, Derek. There's a lot of options for taking on people at the start. They don't necessarily need to be employees, and you could take on somebody as a consultant. So in a consultancy agreement, that means there's no obligation to give them full-time hours, that they're available when work needs to be done, that they count their own taxes, and those are all relevant considerations. But if you don't put them to paper, the position is uncertain, and that's a problem down the line. So essentially, you can use employment contracts, and I include consultancy contracts in that, to comply with your obligations. So if you take on somebody to work for you, you're obliged to give them their minimum terms within a certain period of them starting work with you. So any employment contract will cover that off. It's actually a full statement of their terms, and it defines and regulates the relationship. So sometimes in the early stages when people have started a business, the relationship isn't quite clear. Are we doing this together? Do I have an ownership in this business? We might talk about, in time, we might offer you shares. And if there's no employment contract there, then sometimes it's difficult to argue. So I had an IT company that I dealt with there lately, and they had originally worked with a software developer. So he had developed their software that was central to their business idea, but essentially they had employed him, but there was no employment contract. So it was going to be a potential difficulty that when we looked to take on investment into the company, one of the issues the company had to state to the investor was that there was nobody who might think they have an interest in that company, and obviously the developer was there. Now, as it happens, the same guy he was taking on a new job and he needed a reference. So at that point, I made sure that if he wanted his reference, he would have to sign confirmation of the position, the actual position, that he didn't own any IP in this company. And we were able to tie it off there. But because that scenario arose, we were able to do it. If that scenario did not arise, we potentially had somebody there who claimed an ownership of the company. And so essentially, the last point there, employment contracts, they're essential to protect the IP of a company, the intellectual property, and what's valuable to the company. Terms and conditions of business, I won't run through them all, but T's and C's are essential to any business, and those, I kind of wanted people here to have a cheat sheet, or if they're doing business with somebody, whether that's selling a product to somebody as a business or as a sole trader, or if they're providing a service, there's a number of things you should cover off. For example, the scope of the service. You need to tell people what you're doing and what you're not doing. And if you give them material, that's kind of that you put your hard graft into creating for your business, they don't own that material, that you own that. So that's just a little cheat sheet that people can go through. And my principal one, I've highlighted one on the next slide, are payment clauses, because this is the one that people come to me time and time again, where they've put together their own terms and conditions, which is fine. I have no difficulty with that. But the payment clauses are uncertain, so they've no recourse when the people don't pay. So your payment clause, basically, you're telling people this is how you will pay us, needs to set out that the prices are set out in the schedule contract. So they have a note of what your charges are. That you have some facility where you can vary those charges by agreement. That the price that you're charging is has to have VAT on top of that, because a lot of people, there's a lot of ambiguity there, and people will come back and say, well, I wasn't aware there was VAT to be paid on top of your agreed price. So that needs to be set out. And the length or term of credit, and the payment of interest in the event that they don't pay you. People don't often have that in their terms and conditions, so they're still looking for the original amount 3 years later, and it just doesn't merit still chasing up that amount sometimes. And I mentioned this as our last one: confidentiality and non-disclosure agreements. Essentially, early stage companies often deal with, as I said, potential investors, potential mentors, and they have to disclose some of their business ideas. And you want to make sure that people don't run off with your ideas. If you're looking for investment into your company or your business, an investor is going to ask, have you disclosed this to anybody else? Is there any reason somebody else couldn't go off and do this business themselves? And you'll say, well, I did disclose it to somebody, but I got them to sign a short confidentiality and non-disclosure agreement, which means they can't use that, and if they do, we have recourse to them. So you're looking to protect the company in the circumstances where negotiations break down or nothing happens. And I will just use one caveat here. Commercial awareness, the last point there. Commercial awareness is huge for companies and for people talking to people. If somebody runs off with your business ideas, there's no amount of money really that can kind of compensate you for that, because it's your life essentially. It's your life's work. So you need to be careful about the people you deal with, see if they have a track record, and you also need to decide, do you actually need to disclose everything? Can we talk about our Coca-Cola product without telling them what the secret ingredient actually is, and so that they won't be able to run off and replicate our business. So those are just some of my tips for kind of early stage business from a legal perspective, and I've kind of some useful references there that I often kind of get clients to look at. They're good general pointers to both the obligations that a new business have, and kind of the steps that they might take towards raising money. Just one last point. Derek mentioned at the outset about business plans, and increasingly business plans are forming a huge part of the process for our companies that are taking on investment. For example, I dealt with a company last week, they raised Enterprise Ireland money, and Enterprise Ireland have specifically in their investment documentation, they've said that we will invest, we'll give you money, we'll take an equity in this company, but the condition is that that money will be spent in terms with your business plan. So Derek kind of mentioned a business plan. Obviously, that's where you want to go with your company, but it also regulates how your company is run, and increasingly investors are looking to use them as a way of controlling how your company uses their money. So thanks everyone, and as I said, feel free to contact me if anybody has any queries or if any questions now. I think we can go through them now, Derek.
Okay, thanks very much, Kevin. There's a question in there just in terms of, I suppose, the costs associated with setting up sole trader versus setting up limited companies. Are they prohibitive, or should the default be to go for limited company at this point?
Yeah, I think the default should be to go for a limited company if you're looking to go into business myself. The the cost is, I suppose, not in setting up or incorporating the company. I mean, that's to be honest, it's generally just the fees, the CRO fees, and you're talking about a couple of €100 to get your company set up. The cost really is that, obviously you need to file accounts every year, and you'll have to set up, kind of engage an accountant. And I suppose if that's going to be an issue, well then maybe you might remain sole trader. But the costs are nominal and the protection is huge. So I would have to say the default position should be a company limited by shares.
Okay, okay, very good. There's another question there just in relation to marketing and getting off the ground, like where to spend. Should you start spending money on marketing? Is it online? Do you go offline? And the answer is there is no right answer for that, but I would always say understand how much it costs you to get each new customer. Also understand, how good your own sales process is. If someone does call you and wants to buy from you, there's no point spending lots of money getting people to call you if you are not able to actually close the sale when they do phone. So I would say don't spend anything on marketing until you have defined your sales process first, and until you have decided what you actually do when a customer does come on board and how do you keep hold of them. If there's questions as well, you can just type it into the chat box there if you can, please. There's another question as well there. It's probably for you as well, Kevin, in terms of trademarking and that sort of thing. Is that something that you cover?
Yeah,
Copywriting.
I do. Yes. But copywriting is you don't need to register for copyright. If you create a work, it's automatically copyrighted. So that's not something people need. People often see the C symbol at the bottom of a document. You don't there. It's natural, and it's kind of inherent. You don't need to register. But yes, trademarks are something people think about. I generally don't see the point in trademarking until some value has been generated in the business, because trademarking is not, it's not exactly cheap. If you're looking for a community trademark, which is trademark protection across all of the EU, that's going to cost about €1,700, which is enormous amount of money for a startup business, an early stage business. And I actually don't recommend, until we start building up some value, I don't recommend trademarking until that point. But yes, it's something we cover. Yeah.
Okay, okay, very good. And the other thing, there's one question that was emailed in before. It was just in terms of getting a template for a business plan. I know I can give you a template for a business plan. I can actually give you a template for a business plan if you're in startup mode, or if you actually have an existing business and you want to redo a plan, we can do that. And I would reiterate that the important thing about a business plan is the actual the exercise of doing and completing the plan yourself. So the last thing you should ever do with a business plan is to give it to one of your team or to give it to someone else to do on your behalf. At the end of the day, it's your money. It's up to you to kind of put your thoughts on paper and start to develop a plan for yourself. But I have a template. I'm sure Kevin would also have business plan templates in relation to Enterprise Ireland in terms of what they look for. Would that be
Sure.
correct,
Yeah.
Kevin?
Yep. We
Okay.
do. Yes.
Um, we said today that we would last for 45 minutes today, so we're at the 45 minutes. I want to respect everyone's time as well for coming on the webinar. Again, there'll be a copy of the webinar if you want it, but if you have any questions for either myself or Kevin, just feel free to email us back and we'll help you. But thanks again for coming along, and there's a email in from Tim that's saying can't type in questions. Sorry, Tim. Not sure why that is. Let me just think here 1 second. Maybe just to change it. If you want to type in a question, 1 second. It should be enabled now. Sorry, Tim. Okay, there's you typing questions there now, Tim. I think if you want to type, and then Morgan is typing as well. I think. Is that enabled now, Tim? So the other question we had as well, just in terms of I suppose getting started. I said at the beginning like that it's a marathon, not a sprint. So the most important thing is when you get into business, understand that you'll be in the business for a few years. So make sure you think about it loud and clear before you get in, and understand that you will have sacrifices to make. Question there from Morgan: is there any issue changing from a sole trader to a company after setup? Do you want to take that, Kevin?
Yeah, from a legal point of view, no. It's a relatively simple assignment of intellectual property normally, that would need to happen. What I would think from an accountant perspective, and I deal with accountants quite a bit, yeah, it'll be a different type of accounts you're filing. You need to file accounts with the CRO, not for the first file, but in time you will need to. So it's more of an accountancy matter, but from a legal perspective, it's very easy to do.
Okay, very good. There's a question there from Tim. Thanks, Tim. Is there any law regarding the giving of credit? Is that in terms of whether you should or shouldn't, Tim, or is it just in terms of your ability to collect money afterwards?
Yeah, I'm just wondering the same question.
I don't think there's any law in relation to giving credit.
It's a necessary evil, I'm afraid.
Well, I often say to people at the beginning, like, give as little credit as you possibly can, because sometimes it's not actually necessary, and it's not. It doesn't determine whether you're actually going to get the business or not.
Generally, the standard is that credit is afforded for 30 days after the invoice is raised. That's the standard in our standard terms and conditions, and it depends from industry to industry. But there's no law as such in terms of being able to give it or not able to give it.
Okay. Does that answer your question, Tim? I know Tim is saying, it does answer his question. Okay. I would always advise my clients to keep the credit lines very tight. And especially if you're in a business where if you're selling something that they're not selling on, then the requirement to give credit is less so. If you're in a business where your customers are selling on what you're supplying them, then there might be more of a requirement for credit, because they might want to sell it before they pay you, to kind of shorten their cash gap. But if you're selling a service where they're like, for example, if you're a signage company, the day that the sign goes up on the wall of the company, that's the day that they're most happy with it. That's the day they're most happy about paying you. But a lot of people, they forget to ask for the money. So, and then as time goes on, people begrudge it to you. So don't be afraid of asking for your money. There's
Sure, and I suppose in the early stages, Derek, just to say that keeping the tight credit lines, because you haven't dealt with these people before. Normally, you haven't established a relationship, and it's more difficult. You may not know the people you're dealing with, so therefore the credit lines become more critical in the early stages than they are in later stages, when you've built up developing business and you're relying on that contract paying you to keep things going.
Okay, there's a question from Kevin there. If a sole trader has a business gone wrong and has a judgment against them personally, what are the real collection procedures that the creditor can employ?
Yeah, it'll often depend on the terms of the contract with them, but essentially you've answered the question yourself there, Kevin, in that it's a judgment against them personally, so that that would affect them in if you go to take out loans, you may not get that loan because of the judgment, and that judgment will only be cleared when you repay that money. To affect a judgment, then you can move on a judgment. So we'll say, for example, your creditor has a lot of options. You could get a judgment against them personally. You could get a judgment against property that they own, so that when that property is sold, that you be paid back, or that you could enforce them to sell certain property. So they normally engage the services of the county sheriff to do that. There's a number of options, and it depends really on the situation and the situation in which the debt arose. So if you've any, if you want to kind of contact me to talk about that further, Kevin, feel free to do so.
Okay. Okay, that's it. Tim has asked a question. Tim says, with regard to the business plan and researching the market, what if a new product's not yet marketed, where there's no previous history of sales? What is the process? I guess That's it. It's an interesting question. If a new product has been developed, I would imagine that someone has given some consideration to there being a requirement for the product. That's sometimes it's better to be kind of a fast follower than a kind of an innovator. And there's a lot of people like to get to market first, but if you're kind of a tight second, you might have a better chance because you'll see how the first guy is getting on. So it depends on where you want to position yourself in the market. Obviously, the earlier you're in, the higher margin you can get, but also the rate of, I suppose, products that don't succeed because they're the first in is quite high. Does that answer your question, Tim? Is that what you mean? Wait for Tim to reply. Um, okay. What if you have a great idea according to others but no money? That's where Kevin comes in because Kevin works with a lot of innovation funds and things like that. Do you want to answer that, Kevin?
Well, I do, yeah. But that's what people ask me most, I would think, is where can I get funding, or do you know people who'd be interested in funding this idea? And I mean, there are a host of options out there for companies with good ideas. So great idea according to others, but no money. Um, I, there are a number of supports. Like, I mean, I hear a lot of, I know of the Competitive Start Fund with Enterprise Ireland. That's where most people will come to speak to me first, where they've got EI funding. So that's Competitive Start Fund, High Potential Startup Fund. There's commercialization funding where you haven't incorporated and you want to research an idea. I've heard of people who didn't qualify for EI funding, but they went to the City County Enterprise Board and they were able to support them with kind of innovation vouchers. There's leaders grants, there's Údarás na Gaelta grants, there's a whole host of options, and I suppose it's something I've been thinking about putting together as kind of one, kind of piece of literature that people could understand what's out there. But we're kind of in an innovation intensive period in this country where there's a huge drive towards innovation and towards supporting small businesses, and there are certainly a lot of supports out there. I'm not sure they're marketed very well, but there's any amount. Then you normally
Yeah.
need to target what's specific to your sector. Like the certain types of funding will be in certain areas, but if you have the potential to create jobs, it's very unlikely Enterprise Ireland won't listen to you if you have a good business idea. I suppose it is having that good idea, Tim.
It is, and the other thing to say there is that, that's where the plan comes in as well. Because if you can articulate your idea on a good plan that exhibits your own emotion or your own confidence in the product, you'll attract in investors. But again, it goes back to the very first slide we said about the team that you need to surround yourself with. There are people out there who will know where to go for funding. There's people out there who will know where to go to develop ideas. And sometimes the enterprise boards can stymie that process, but don't just stop there. Like, there are other people out there. And I think the first thing is put your hand up and say, okay, point me in the right direction. Okay, if there's no other questions, we'll wrap it up for today. But again, you have our email addresses, and we're happy to help you on email in between now and then. But thank you all very much for participating today, and hopefully you got some value from the webinar. This is the first webinar of this type that Kevin and I have done, so there's probably some rough edges that we'll work on as well. But thanks you all very much, and we'll wrap it there. Thank you.
Thanks, Derek, and thanks everyone for attending. Take care.
Okay, thanks. Okay, Tim, if you have any more questions, just email them through to me and I'll answer you directly myself. Yeah, thanks. Bye-bye.